So today we're going to talk to you about borrowing cost. Borrowing cost is covered under Ind AS 23. We've already talked about how do you need to deal with accounting under Ind AS 16 for property, plant and equipment, and also under Ind AS 38 for intangible assets. I would strongly recommend you to understand that how the whole process of capitalization operates for before you actually learn about the borrowing cost related concepts, right? Now, when you think about borrowing cost, there are two things is what we are trying to understand here. One is in relation to whether the borrowing cost is an element of revenue expenditure or the borrowing cost is an item of capital expenditure, right? So, and borrowing cost, when we think about that, let's say you have borrowed money in the form of debt from an external third party. If you borrowed money in the form of a debt from an external third party, you are required to pay interest on that. Otherwise, why someone will lend you the money? So if someone is going to lend you the money, then they expect to be rewarded by interest. Or there could be another form of funding which you receive, which is equity capital, right? So if you have received equity capital, then any return which you pay to the contributor to the equity capital, which is in the form of dividend, for example, now that is not eligible for capitalization, or that is not an item of expense in your profit and loss account. So here what we are trying to look at is that the interest is what you pay in relation to borrowed capital, whether that interest is a revenue expenditure for that period or that interest can actually be capitalized with reference to an asset which is under construction, an asset which you are building, which is expected to generate future economic benefit. So we need to understand that what is being called as qualifying asset, right? So we need to understand what is being called as qualifying asset. Once you understand what is a qualifying asset, so in relation to borrowing cost, what we need to understand is that how much is the money what you have borrowed, right? Then for what purpose you have borrowed the money. Is there a specific borrowing? Is there a general borrowing? Is what you've done. So what is meant by borrowing cost? What is meant by qualifying asset? How are you going to calculate the extent of borrowing? How do you determine the borrowing which is eligible for capitalization? What are different types of borrowing? Different types of borrowing means whether it's a specific borrowing or whether it's a general borrowing. How should the rate of capitalization to be computed? When does capitalization of cost commence? And when does cessation, in a way, when you stop doing the capitalization of borrowing cost? How should borrowing cost be presented in balance sheet, and what disclosures are required to be made? So when you look at the whole concept of borrowing cost, the relevance of this standard is in the context of that what is it, ordinarily, let me rephrase. Ordinarily, all borrowing cost which you incur should be charged to profit and loss account as an interest cost, as a period cost. All right. Now, the complexity arises when you are actually incurring borrowing cost to build an asset. Build an asset which is going to generate and provide future economic benefit. If you're building an asset which is going to generate future economic benefit, then the question comes that what is the cost of building that asset? Now, when you again thinking of cost of building that asset, there is a cost of purchase, raw material, labor, etc., etc. There are taxes, duties, what all goes into that cost of building that asset. One of the component of cost of building that asset is also the financing, the form of financing which you have deployed to build that asset, and that is also an eligible cost of capitalization. And that's the purpose, is that what we need to understand this standard in greater degree of detail to say that what interest cost is I'm able to capitalize in relation to a capital work in progress which is there in my financial statement, whether the interest cost which I have incurred is eligible for capitalization with reference to capital work in progress. If you do not have a capital work in progress in your balance sheet, then essentially whatever interest cost is you going to incur, all of that is charged to profit and loss account as a period cost, immediately expensed when incurred. But if you have certain capital work in progress which do meet the definition of something what is called as qualifying asset, and we will try and understand each of these concepts in more detail as we progress through this conversation, then you will be able to appreciate that how do I determine that what interest I need to capitalize, what percentage of interest is what I need to capitalize for, in relevance to what type of assets is I am eligible for capitalization. So there are accounting rules, accounting principles is what we need to understand to determine how much to capitalize, when to capitalize, with reference to what asset I need to capitalize, is what we're trying to understand in the context of borrowing cost. And that's the relevance of this standard, from an Ind AS accounting framework perspective. So before we jump on to the actual standard, let's try and understand the relevance of this from an examination perspective. And when I see the trend line here, that twice this subject has been examined in your question paper, and the most recent was in November of 2019 when it was examined for 8 marks. So this is not an accounting standard which has been looked at in every term, right? Only in 2019 is when we see recently this has been picked up, and the total marks which were allocated to this was 8 marks. So we're going to look at the standard. Still, it is important for you to understand the principle, understand how the principles which are stated here do going to operate if you were to be looking at this from an application perspective. And we will also try and solve the question which was asked in the examination in November 2019. So as we look at every standard, right, I'm going to focus on the scoping part of it, that what's the scope of the standard, what is covered in this standard, and then we're going to look at the recognition, then we're going to look at the measurement, and then we're going to look at the disclosure. So all different components of the standard, the way the standard's been written, is what we will try and cover in fair degree of detail with number of examples. I've got number of examples which I'm going to cover, try and explain each of these topics, and then we also going to have more practice questions as well for you. It is important, the most important thing for you is to get the concepts right. Once you're clear on your concept, once you're clear in your principles, you will be able to again build the answers. You'll be able to think through the answer as to why this has been applied in this particular manner. Once you're clear on the principle as to why the accounting standards are saying that this is how you need to do, why you need to do it, and that's what my attempt will be, to help you understand the whole logic and principle of some of these accounting standards. So when I look at the scoping part of the standard, is that it suggests that you got to look at the borrowing cost. Once you've looked at the borrowing cost, you got to look at the directly attributable to acquisition, construction, or production of a qualifying asset. Something what is, we call it as borrowing cost, which is specified borrowing, right? Something which is specific borrowing in relation to acquisition, construction, or production of a qualifying asset. What is also important for you to understand here is the qualifying asset, right? And we will talk in a lot more detail what is the meaning of a qualifying asset. So if you've done a borrowing which is in relation to a specific borrowing, right, for acquisition, construction, or production of a qualifying asset. Any interest cost which you incur till the point in time it actually gets completed for the purpose for which it has been acquired or is been under construction, so that starts generating probable future economic benefit, you got to capitalize the interest cost which has been incurred till that point in time. If the other borrowing cost which you have incurred, though, that you need to look at as an expense. However, if you have capitalization process going on and you don't have a specific borrowing but you still have capital work in progress, we will also try and understand that how do you actually capitalize general borrowings which are available. But if you have total borrowing cost, there are borrowing costs which can be attributable to the construction, acquisition, or production of a qualifying asset. Such interest costs attributable to any capital work in progress, that has to be capitalized. The other borrowing costs are period cost and which cannot be attributable. So here I'm going to add more to say if it is a specific borrowing or a general borrowing, right, which again can be attributed. If this can be attributed to the construction, acquisition, or production of a qualifying asset, then you are supposed to capitalize that. Otherwise, you need to expense that interest as incurred. And as I said, we're going to talk in a lot more detail. So when you talk about, or when you think about borrowing cost, what does that mean, right? The borrowing cost is an interest expense, at a very simplistic level. Interest expense, which is what you pay to the bank or to any lender. When I say bank, it could be any lender. You may raise debt by way of issuance of debentures or by way of direct bank borrowing, or by borrowing money from your friend, or from other corporate bodies. In whichever form which you have borrowed money, which is liable for an interest, that interest expense forms part of your borrowing cost, including the commitment charges and all of that, what you pay, because that's where we look at under Ind AS 109, the effective interest rate method. Finance charges, interest in respect of lease liabilities recognized in accordance with Ind AS 116, is also a part of borrowing cost. And this is another area which you need to understand: exchange differences on foreign currency borrowing as an adjustment to interest costs, right? So if you are an Indian company, you can borrow money in your functional currency, which is Indian rupees, right? Or you may decide to borrow money in a foreign currency, say US dollars. Now, if you were to borrow money in Indian rupees, you will end up paying, let's say, interest at the rate of, say, for example, 10%. But if you borrow the same money in foreign currency, you may only end up paying interest at the rate of 6%. The reason for this difference is the fundamental difference in the different set of economies, different set of lenders, the play of currency, the play of interest rate arbitrage, the play of currency risk, what is out there. So there are several factors which goes into determination of an interest rate which is to be charged, and also linked to the currency in which the debt is denominated. So if you borrowed money in Indian rupees, you may end up paying 10%. If you borrow the same amount of money in US dollar, you may only end up paying interest rate of 6%, but then you are exposed to the currency fluctuation risk. Now, what the standard suggests that if you are exposed to the currency fluctuation risk, to the extent of the currency loss, if you're incurring a foreign currency translation loss in relation to such foreign currency borrowing, to the extent of interest saved, because you've now borrowed money in a foreign currency and you're paying less interest, which is 6% and not 10%, to the extent of the interest saved, you are also consider that foreign exchange loss as an additional item of interest cost only, and that also forms part of your borrowing cost, from that perspective. So we have to look at borrowing cost in its totality. It is not only what I'm going to pay to my lender. I'm going to look at it what I'm going to pay to my lender. I'm also going to look at it what I'm going to pay other charges because of Ind AS 116. Also, I'm going to look at the foreign currency losses. The argument is that, in fact, let's say there are other items of liabilities on which you are exposed to interest. End of the day, all of that. So wherever you are paying interest, right, if it is paid by way of interest, that interest is forming part of your borrowing cost, and then you need to appropriately evaluate and determine whether that is eligible, that is a borrowing cost under Ind AS 23, and then how much of that interest cost is actually eligible for capitalization if you have a capital work in progress, and or that is to be treated as a period cost to be charged in the profit and loss account. Let's try and look at this with the help of an example. Company X raises loan for INR 100 crores to fund the construction of a new building. Net proceeds after transaction cost are INR 98 crores. Interest paid on the loan is INR 5 crore per annum. So I've raised 100 crores. The bank has charged me a processing fee of 2 crores. So net is what I've received is 98 crores. And there's an interest cost of 5%, which is 5 crore per annum on 100. The term of the loan is 4 years, and the effective interest rate is 5.57%. And you will learn more about the effective interest rate method is when we will talk in lot more detail under Ind AS 109 on financial instruments, because that is when you look at what is actual interest cost. The coupon rate is 5%, but you only receive 98. What is the meaning of effective interest rate? That you have to actually pay 7 crore to the bank, right? For the money which you have received is only 98 crore, because I have to return 100. Also, I have to give this, 5 crores of interest on that, right? So I have to actually pay 7 crores. So if it's a 1 year period loan, I'm actually going to pay you 7 crore. But if it is, let's say, a 4-year loan, which is in this case, so how much I'm going to pay to the bank, which is the interest for 4 years, which is 5 into 4, 20 crores, plus this 2 crores of commitment fees, which I paid to you. So in total, I'm going to actually pay you 122 crores, right? 122 crores. Now this 122 crore with reference to 100, right? And then you figure out your appropriate effective interest rate, which actually is not 5%, but actually it is 5.57%, right? Bank, when they are saying that they're charging 5%, they're not charging 5%, they're charging 5.57%, and that's the whole concept of effective interest rate method. The question here is to calculate the borrowing cost for the loan during the term of the loan. So term of the loan is how much here? 4 years. 4 years is the term of the loan. And the question here is that calculate the borrowing cost. I need to calculate the borrowing cost. So when I'm going to look at the borrowing cost here, it's very simple. I did this math here for you. Opening balance is 98. Effective interest rate, the information is 5.57. Apply that, you get to 5.46. This is your revised 5 is paid out to the bank. My revised carrying value of the loan is 98.46. And then again, I apply the same percentage. It's 5.48, 5.51, 5.55. My total interest, which I'm going to pay, is 22. 22 in other simple words, in this example, you can say on 100 crore for 4 years at the rate of 5%, I'm going to pay 20 crore plus 2 crores is the loan processing fee which I paid. The total is 22 crore. When that 22 crore is actually attributed using an effective interest rate method, your annual interest cost comes at the rate of 5.57%, even though the outstanding was 100 crore. The bullet repayment is at the end of the 4 year. Your actual interest cost is different in every year. In the year 1, it is lowest. In year 4, it is highest, because you are actually now using the highest amount of money at the end of the year 4, which is using the effective interest rate method, right? Because this 2 crore gets accreted, every year with reference to the outstanding amount. And that's how the whole methodology of effective interest rate method work. And the total interest cost in this example is 22 crore. I hope this example is clear to you. And that is the whole concept of effective interest rate method. And so bank is saying that 5%, but they're not making 5%. They're actually in this transaction making 5.57%, and they're not making 20 crores. They're actually making 22 crore of profit by lending you 100 crores, and they've not given you 100 crores. They've actually given you only 98 crores, and that's what is important for us to understand. Now, So we've talked about the concept of borrowing cost, and then we say what is actually forming part of borrowing cost, which is, let's say, anything which you have borrowed specifically, on which you're paying interest, or if you're leased asset on which you're paying, which is you are accreting interest even though it's notional in nature. And then there is a foreign exchange loss, you have borrowed money in a foreign currency. All these 3-4 things put together. And then if you have any other component of interest which are actually being charged in your profit and loss account, all these interests are eligible to be qualified as a borrowing cost. Now this borrowing cost is when you're doing any asset which is in the production construction, that is something which if you have anything like that, you can consider that as an asset which is eligible for capitalization. If you don't have any capital work in progress going on, then anyway, every interest cost which you have is a period cost charged to P&L, right? So the whole battle here is to figure out that whether the interest cost which I've incurred, is that interest cost is eligible for capitalization, is under the framework of Ind AS 16 or under Ind AS 38, looking at the principles which are articulated under Ind AS 23. Now, one of the other concept for you to know that what assets which are eligible for capitalization, on what assets you can actually capitalize the interest cost, is what is being called as the qualifying asset. Qualifying asset, right? Now the definition of qualifying asset is very, very important for you to understand. So what is a qualifying asset? Qualifying asset is an asset that necessarily takes a substantial period of time to get ready for its intended use or sale. Remember that thing, substantial period of time, substantial period of time. Now, the interesting part is the word substantial is not defined in the accounting standard. So we don't know what is the meaning of substantial period of time, and hence it's an element of judgment. It's an element of judgment. And we see some diversity in practice, but in general, we when we apply this in practice, we say that substantial period of time is something which means more than 12 months. If you are building an asset, or whether you're building an inventory which is generally going to take more than 12 months, the substantial period of time as an asset that normally takes 12 months to be ready for its intended use will usually be a qualifying asset, right? So 12 months is generally a criteria which is being used to consider an asset which is in construction as a qualifying asset. There are several examples. Example of a qualifying asset is a manufacturing plant, power generation facilities, investment properties, inventory that require a substantial period of time to bring them to a saleable condition, but does not include assets which are ready for use or sale when acquired. If you purchase something which is ready for use, then of course it is not something which qualifies as a qualifying asset. Qualifying asset means something which is going to take substantial period of time, and substantial period of time is defined as is actually not defined, but the guiding principle is that something which generally takes more than 12 months to get ready for its intended use or sale. If that been the case, then that's something which qualifies as a qualifying asset. So this definition of qualifying asset is very, very important for you to understand and remember. Qualifying asset is something which takes a substantial period of time, and substantial period of time to build the asset, substantial period of time to build the asset, or it can be inventory as well. Now, if you were to take substantial period of time is actually not defined. So but in general, the practice is that, something which is actually going to take something which is more than 12 months, right? All right. So now we're going to look at example which talks about qualifying asset. So here's the question. Aura Limited is in the business of developing investment properties. It has incurred expenses towards getting a regulatory approval in relation to construction of one of its property. Further, it has purchased a machinery for construction project, which Aura Limited will use for multiple projects. So whether the expenses on regulatory approval and machinery be considered as qualifying asset. Okay. So essentially, the question we're trying to examine here is that when you look at Ind AS 23, right, and as we've been talking, right, qualifying asset means something which takes substantial period of time, right, and an expenditure has been incurred. Okay. So
And substantial period of time, though not, there's no bright line here, but is commonly understood, is from a practice perspective, it's like 12 months, right? So when you look at in this example, the machinery which has been purchased for construction project, it sounds like something which is ready for use. So it's something which is ready for use, then there is no qualifying asset, right? You can't capitalize any interest cost in relation to such asset. Now, when it comes to investment property, and investment property, as we discussed, right, investment property means land or building, right, as there in India's 40. So when you look at investment property, land or building, they ordinarily take substantial period of time to get completed, and the regulatory approval is very much part of the whole project, right? And hence, any expenditure incurred toward obtaining regulatory approval is also a part of the qualifying asset. So let's look at the solution here. Regulatory approval, yes, right? A regulatory approval is taken for a specific property and is important part of construction, which will take a substantial period of time to get ready for its intended use, and hence will meet the definition of a qualifying asset. So it meets the definition of a qualifying asset. Now, when we look at the machinery, no, it doesn't meet the definition of a qualifying asset. Why? Because machinery will be used for multiple projects, and also the machinery is purchased in a usable form, and no further activity is required to get ready for its intended use. Hence, will not be considered as a qualifying asset. All right. I hope this is clear to you. So now I'm going to look at this example, right, which talks about the capex which we are doing in relation to a telecom license. Okay, so Tower Limited has incurred expenditure for acquisition of a telecom license. The said license can be sold or given on a lease to outside parties who are interested, but Tower Limited has an intention to use the same in operating its own network. Okay. Tower Limited starts the development of the network on acquisition of the license. So essentially, we are trying to say the license can be sold, but my desire is to actually build out a telecom network. Now, the question here is, can Tower Limited capitalize the borrowing cost incurred on acquisition of telecom license till the time the network is ready for use? That's a very classic example, right? So you have an asset, and the asset can be monetized in a form which is in a different form. Okay, but your own objective, entity specific assumption that I'm going to actually help and build and develop the network, not sell the license, right? And essentially, when you look at a qualifying asset, it is the entity specific assumption which is more important for us to evaluate whether it is a qualifying asset or not. And if the telecom license, I'm not going to use it to generate economic benefit unless I get the network also being developed, and that's going to take substantial period of time. Then the telecom license is in a way like an input, right, to the overall development of the telecom network, and hence the interest cost which you incur till the time you roll out the telecom network, so to say, or it's ready for use, that interest is allowed to be capitalized. So let's look at the solution here. The intention, right? The intention of Tower Limited is important for the analysis. The fact that the license can be sold or leased will not have any impact on the analysis. The license has been specifically acquired to be used in operation of the network, and hence directly attributable to the cost of the larger project, which meet the definition of a qualifying asset. Therefore, the borrowing cost on the telecom license can be capital.
Now, what are there certain scope exceptions? Everywhere there are scope exceptions. Scope exceptions. So what is not covered? Qualifying assets which are measured at fair value, like biological assets. If you are biological assets which are accounted for under Ind AS 41, you are outside the scope of Ind AS 23. You're not supposed to capitalize interest looking at the guidance under Ind AS 23. If the actual or imputed cost of equity, including preferred capital, not classified as a liability, which is what I was talking about, that if you actually obtain funding by way of equity on which you pay dividend, etc., which is not classified as a liability. If it is classified as a liability in your P&L, in your balance sheet, and then there's an interest cost which you accrue, then that interest is eligible for capitalization, but not otherwise. Similarly, inventories which are produced in large quantities on a repetitive basis, that also is kept outside the scope of Ind AS 23. And there are several examples like dividend paid on equity shares, cost of issuance of equity, cost of irredeemable preference share capital are not considered as borrowing costs within the purview of this standard. So if it is in the equity box, anything which you pay to the equity owners, that's not part of the borrowing cost. If it is in relation to qualifying assets which are measured at fair value, which are covered under Ind AS 41, which is your agricultural assets, or if it is in relation to inventories which are produced in large quantities on a repetitive basis, that also has been kept outside the scope. That means you are not allowed to capitalize interest cost in relation to these specific scope exclusions, right? Why the scope exclusions is that when you're not allowed to capitalize the interest cost, let's try and understand with the help of a few more examples. A shipbuilding company making ships on order on behalf of its customers. A ship would require a substantial period of time, assuming a substantial period of time is more than 12 months, to bring it to a sellable condition. The inventory for such business shall be considered as a qualifying asset. Right? That means if you're incurring interest cost, if you borrowed money to do this building construction, that interest cost is not a period cost, it's not charged to the profit and loss account, but actually is getting loaded to this inventory. However, a car manufacturing company, on the other hand, makes cars. That does not require a substantial period of time to bring them to a sellable condition. These would not be considered as a qualifying asset. So this is not considered as a qualifying asset. This is considered as a qualifying asset, right? So in the second situation, you are not supposed to capitalize the interest. In the first situation, it considers as a qualifying asset and you have the ability to capitalize them, right?